Hello everyone, welcome back to the FM session here. Today I will be solving a case which was appeared in the year 2013, June, July. It's a VTU second semester MBA Financial Management subject. And the question appeared in June, July 2013, and the question number happens to be 8. In that question number 8, it was asked for 12 marks. Now let us review this question and then we'll see how to go ahead with the solution. Well, in the question, they have given that ITC Limited has decided to purchase a machine to augment the company's installed capacity to meet the growing demand for its products. There are three machines under consideration of the management. The relevant details, including estimated yearly expenditure and sales, are given below. All sales are in cash. Corporate income tax rate is 40%. Interest on capital may be assumed to be 10%. And they have given four columns with particulars: machine 1, machine 2, and machine 3. Now, if you look at the particulars, they've given initial investment required, which is 3 lakh for all the machines. They've also given the estimated annual sales. They have given the information related to the cost of production, and they are direct material, direct labor, factory overhead, administration cost, selling and distribution cost for all the machines. Also, now they say that the economic life of machine 1 is 2 years, machine 2 is 3 years, and for the machine 3 also it is 3 years. The scrap values are 40,000, 25,000, 30,000 respectively for all the three machines. You are required to find out the most profitable investment based on payback period. Now, when you evaluate each machine, you will have to take a decision of which machine to be preferred on the basis of the payback period method. Therefore, by this we understand that since there is no cash flow after tax, which is the requirement to figure out the payback period, now the target for us is to proceed for determination of CF80 for all the three machines. Now, let me write here determination of CF80. You can start working parallelly with me. I recommend you to have this question with you. Anyway, you already have a question booklet. So look at the question paper and then start solving with me. Let us have four columns. One which goes with the particulars, and then machine 1, machine 2, and lastly machine 3. They have given the details which are to be considered here. In my last video, I talked about for a company, the cash inflow, the ultimate cash inflow happens to be from the sales, right? If they have given the income, that is a different case. But here, they have not given any information about the cash flows. Now we need to identify the cash flow of tax for this particular ITC Limited. Now we know that a company will be receiving the ultimate cash inflow by the sales, and it is already given here in the question. If you see here for machine 1, it is 5 lakhs, for machine 2, 4 lakhs, and for machine 3, 4.5 lakhs. So I'll be writing the same here, the values. For machine 1, it is 5 lakhs. Machine 2, it is 4 lakhs, and machine 3, 4,50,000. We certainly know that we will have to deduct some expenses from the income which we have got, right? You will have to deduct the expenses, and the expenses are given here. They have mentioned the direct labor. This problem seems to be very clear and straight. We have direct labor. They have given the direct labor. Even you can consider the direct material. Yes, direct material, direct labor. Then you have factory overhead. Factory overhead. From the question, if you see administration cost, even that is also an expense which you will have to deduct. So I'll be writing the administration cost. And then I'll also be taking the selling and distribution cost, which happens to be the expense. Selling and distribution cost. So I'm just mentioning here the particulars which are to be considered. Now let's say if you deduct all these expenses from the sales, it is clear that we get the before tax cash flow or income before tax, right? So I can write here cash flow before tax. If you want to write it in words, you're most welcome. You can say cash flow before tax. We also know that when we get the cash flow before tax, we will first deduct the depreciation. When you deduct the depreciation, you get something called as profits before tax. And then you will be deducting the tax at the rate. In this question they have mentioned tax at the rate of, let us see, where is that? Yeah, it is here, tax at 40%. When you deduct the tax, you will be getting PAT, profit after tax, and certainly you will be adding back the depreciation to get CFAT. This we are aware of, and that is the reason I just thought of helping you to proceed with this particular flow. Maybe you can pause this video here and you can calculate what is the solution, and finally you may check the answer once you are done with the calculation, right? So you have an option of clicking pause and then proceeding with this. Anyway, now let us proceed here. For the direct material, the direct labor, the informations are given here. For the direct labor, they have given the 50,000. I'll be mentioning that 50,000 for the direct labor, and they have given 30,000 for machine 2, 36,000 for machine 3. And now if you look at the direct material, it is 40,000 for machine 1, 40,000, and 50,000 for machine 2, 48,000 for machine 3. Factory overhead, let us look into the amount. 60,000 for machine 1. I'll be writing that 60,000 for machine 1. And then from the question, 50,000 for machine 2, and 8,000 for machine 3, 58,000. If you look at the administration cost, it says 20,000 for machine 1, 10,000 for machine 2, 15,000 for machine 3. And lastly, you have selling and distribution cost 10,000 each for all the machines. So we'll be mentioning 10,000 for all the machines. And now, if you deduct all these costs from the sales, you will be getting a cash flow before tax, and that happens to be 3,20,000 for machine 1, 2,50,000 for machine 2, and 2,83,000 for machine 3. Now we need to know what is the depreciation for machine 1, machine 2, and machine 3. Let us take a working note here to calculate the depreciation. We know the formula which is used to calculate the depreciation, that is equal to cost minus salvage value or scrap value divided by life of the asset. Now for the machine 1, let us see what is that we can derive. The cost of machine 1, that is the initial investment, they have mentioned as 3 lakhs. From the question paper, you can take that 3 lakhs minus salvage value, they have given us 40,000 for machine 1. We'll take that also, it is there in the question. And they say machine 1 has got a life of 2 years, so I'll be mentioning that. And now 3 lakhs minus 40,000 divided by 2 will be 2,60,000 divided by 2. And then you will be getting 1,30,000 as the answer. 1,30,000 for machine 1. Similarly, now let's go for machine 2 to calculate the depreciation. Machine 2, what it says, the initial investment happens to be same 3 lakhs, but the salvage value happens to be 25,000. It is there in the question. You can see here the question 25,000, right? And the economic life of machine 2 and 3 happens to be 3 years. It is in the question. So we will take it that 2,75,000, which we get from substituting 25,000 in the depreciation in the initial investment of 3 lakhs, and then your depreciation amount happens to be 91,666.67. Approximately, you can say 91,667 as the depreciation for machine 2. And for machine 3, now we need to figure out for the machine 3. Machine 3, it says that the cost is 3 lakhs and the salvage value they have given it as 30,000 divided by life of the machine 3 and 2 is 3 years. And then now you will see from 3 lakhs, if you deduct 30,000, you will be getting 2,70,000 divided by 3, and then you will see 90,000 as the depreciation for machine 3. Now let us bring this depreciation amount to the table. Now I'll be mentioning 1,30,000 as the depreciation for machine 1 from the working note, and machine 2 91,667, and for the machine 3 I'll be mentioning it as 90,000. Now I'll have to deduct the values from the depreciation values from the cash flow before tax so that I get the profit before tax. Now from 3,20,000, if I deduct 1,30,000, I'll be getting 1,90,000 for machine 1. And for machine B, 1,58,333. And for the last machine, that is machine number 3, 1,93,000 is what I will be getting if I deduct 90,000 from 2,83,000, 1,93,000. Now, at the rate of 40%, if I apply the tax, I'll be getting 76,000 for machine 1, 40% of 1,90,000, and 40% of 1,58,333. I'll be getting 63,333. And for the machine 3 on 1,93,000, at the rate of 40%, 77,200 is what I will be getting as the tax amount. 77,200 rupees. 77,200 rupees. Now, if I deduct the tax component from the profit before tax, I will be getting the profit after tax, which is nothing but 1,14,000 for machine 1. I'll have to deduct 76,000 from 1,90,000 so that I get 1,14,000. If I deduct 63,333 from 1,58,000, I will be getting 95,000 as the profit after tax machine 2. And for the machine 3, from 1,93,000, if I deduct 77,200, I will be getting 1,15,800. And now, this is a PAT, profit after tax. But for me, the target is CF80. Therefore, I should add back the depreciation, and I'll be doing the same. I'll just add the depreciation 1,30,000 to the machine 1, and 91,667 for machine 2, 90,000 for machine 3. And finally, I will be arriving at the CF80, the target, whatever we wanted to aim for. 2,44,000 for the machine 1 that I get by adding the depreciation of 1,30,000 to the PAT 1,14,000. In the same way, 95,000 plus 91,667, I'll be getting 1,86,667. In the same way, if I proceed with the 1,15,800 and 90,000, I will be getting 2,05,800. You can see here you have arrived at CF80. Now, probably you'll be thinking, what is next, right? You should be knowing what is that you have to do with the CF80. Once you get the CF80, then the challenge is with you to calculate the payback period. I'm sure you will be aware of how to proceed with the payback calculation. So now let us proceed in terms of knowing the payback period for these machines. Right. With that information, let us proceed for payback period, payback period calculation for machine 1. We know that PBP for the given data, we can proceed with the initial investment divided by CF80. And for machine 1, we know that the initial investment happens to be 3 lakhs. So we are going with that 3 lakhs. And CF80 for the machine 1 is here, 2,44,000. So let's go with that, 2,44,000. And then when you simplify this, you will be getting 1.23 years for machine 1. In the same way, when we proceed with the machine 2, the same 3 lakhs as the initial investment. And the cash flow after tax, if you see, you have 1,86,667. We'll be writing that 1,86,667, and then you arrive at 1.61 years. Lastly, for the machine 3, when you go for machine 3, you proceed with the initial investment as 3 lakhs, which is given in the question, divided by the CF80 happens to be 2,05,800 from this table, 2,05,800, and then you get 1.46 years. Now, if you compare 1.23 years, 1.61 years, and 1.46 years, definitely you will be giving a rank 1 for machine 1, and certainly rank 2 for machine 3, and rank 3 for 1.61 machine 2. So you will say that the lesser the period, quicker the amount recovery, quicker the amount coming back to the business, and then you will say that the best machine would be the machine number 1 with a payback period which is less than machine 2 and 3. That is 1.23 years is less than 1.61 and 1.46 years of machine 2 and 3 respectively. So that is all about this particular question in terms of deriving the CF80 and then proceeding with the payback period calculation to take a decision. That's all. If you have any queries, you can write to me an email or you can text me on WhatsApp. Thank you so much for watching this. Thank you.